Hey everyone, welcome to today's show, The Final Bar. One of the biggest sell-offs, if not the biggest sell-off in market history today. So we're going to try to make sense of what's happening after a crazy week last week. Volatility Friday with a huge rally on the on President Trump's press conference. We get another distribution today after the Fed taking action yesterday. So we're going to try to slice and dice it from the macro level, the sector level, and the stock level, trying to answer as many questions as possible. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining me every day after the close on the weekdays to debrief on the technical activity, connect the short term to the long term, and what environment could be more important for this sort of take a step back type of thinking than this one, right? The S&P down almost 12% to close at the lows. Mid caps and small caps even more. So we're going to try to make sense of this and connect what's happened today versus last week versus the longer term trend. Try to put this into context. Look for opportunities where there's still some positive movement. You know, my previous role, I was at Fidelity in Boston, and I remember starting there in 2008, and some of the days there in 2008, 2009 felt a lot like today. And I remember sitting in people's offices staring at the screens as the numbers seem to get redder and redder, glowing off the screen. And so we've seen this before, but boy, not to the degree and not to the volatility we have. So we're going to try to make sense of it as much as we can. Let's think about what's coming up, though. We got a lot of people to try and help us make sense of this. Today, we actually premiered Behind the Charts, our episode with Jeff Huge. And again, as much as there's challenges with what's going on in the market, it's such a great opportunity to learn from others, from their routines. How can you help improve what you're doing, get a better, go get your arms around things. And so Jeff had some really good guidance with our conversation with him. Then tomorrow we have Tim Tashler on Wednesday, David Auerbach on Thursday, Cliff Droke. So three fantastic guests to try to help us approach the markets from different angles. And again, I think in this sort of environment, it's more important than ever. Having said that, Larry Williams actually just recorded, we just finished it a couple hours ago, recorded a special broadcast we're going to have on this on StockCharts TV tomorrow at 12 o'clock Eastern. So make sure you tune in for that. We'll have it on our YouTube channel as well. But he's actually turned pretty bullish based on the extremes in price, on the extremes in sentiment. So you're not going to want to miss his more bullish take on buying weakness here. Let's try to recap these markets, folks. And again, I've been doing this for about 20 years or so. I know many of you have invested much longer than that. Some of you probably are earlier on in your journey, but these are rare moves that we are seeing. And what I'll try to show you from the charts is this is, you know, when we talk about technical analysis, it's all about probabilistic outcomes. What should happen, what's most likely to happen based on our analysis of market history. When you get into this environment, though, when the S&P is down 12% at a clip, when it's losing 325 points in a day, these are unprecedented times. And the number of historical examples that you have to compare it to are less and less. So, you know, from a statistical perspective, we're very much in uncharted territory because you know there's only so much you can do from a limited number of observations. But I've always found in this sort of move, what you can do is look back at previous sell-offs, look back at previous bear phases, try to put this thing into that playbook, right? So what has worked at different times? What sort of themes can you pick into? And it's things like, you know, defense over offense. There are people moving to, you know, the big blue chip sort of names and what names are holding up well. In an environment like this, we're going to talk about, you know, that the steep sell-off in stocks and what stocks are actually outperforming during this period. Let's look at the markets. You know, the S&P down big now at 2386, or, you know, the level we've been talking about for a couple of weeks now is 2350, and that seems more and more reachable every day. That could be tomorrow if we get another big down day. Mid caps and small caps down even more. Mid caps down almost 14% today. So again, it's a movement away from the higher, more speculative stuff into the mega cap names, or I guess the least out of the mega cap names. The VIX on this sell-off jumped up 23 points. It's up over 80 now, and I'll show you in one of our 3 and 3 charts how incredibly rare that is. It's happened only one other time in the last 25 years, folks. In terms of sector movements, and again, we're going to get into sectors and we're going to into stocks. We're going to try to approach this from a couple different ways, so I don't want to get too much into it, but just to recap on today, staples, healthcare, the two best sectors, and staples down almost 7%, which on a normal day would be a disaster, but on today was a safe haven of sorts, right? Only losing 6.8% was pretty decent, followed by healthcare, followed by comm services. At the bottom, you have real estate, the biggest loser, down 16%, technology down 14%, financials down there as well, and energy almost there. I was surprised, actually. I would expect with all the retail closings, restaurants and stuff, you'd see consumer discretionary. And some of those charts look absolutely horrendous, don't get me wrong. It was interesting to see that actually tech, real estate, financials down even more than consumer discretionary with all the news, the flow going on. I did want to point out just very quickly, as we're talking about a big picture, because we're going to spend a little bit of time with sectors and with stocks, I just wanted to focus on asset allocation very briefly here. Everything, to be honest with you, for the most part, is selling off with some notable exceptions. And what you'll see today, two areas that are actually holding up pretty nicely. One is the US dollar. Second one is bonds. And let's look at each of those individually very quickly here. So the UUP is the great way to measure short-term movements in the dollar. As you can see, there have been wild swings in the UUP. And again, a lot of these ETFs, a lot of these structures have not really been tested in a super volatile phase like this. Very few things, if at all. Even the market structure has not really been tested in its current format with this sort of environment. So there's a lot of question marks in terms of what's really happening. But overall, with the UUP is a great way to just gauge, day-to-day movements. And overall, again, with this huge volatility, it's still at the upper end of the range. If you look at the range from the last 6 to 8 months, it's sort of been in this 26 to 27 range, and we're still at the upper end, about halfway up through there, but holding up above an upward sloping 200-day moving average. Very few things are still in that sort of environment. So strong dollar, which in general tends to mean, stick with the U.S. as opposed to non-U.S. markets equity-wise. The TLT, if we're thinking about bond prices, this is another place to look. And again, a lot of volatility in here. Sold off Wednesday, Thursday. So really Monday, Tuesday, Wednesday, Thursday, even though we gapped up on Monday of last week, closed more toward the lows. You can see this string of down closes, and it felt like there are people coming out of treasuries, flows coming out of treasuries. This was Friday's action, which closed down a little bit. That's on stocks going up 9-10% at a clip. Now we have the steep sell-off in stocks. We have the TLT, bond prices back up pretty significantly. And so yields pushing much lower, bonds pushing much higher, bond prices. Obviously, the Fed, doing another emergency lowering, going essentially to, almost zero, has certainly, caused that uptick in bond prices, right? So interest rates go down, bond prices are going to go up. Let's look then at gold, right? So another safe haven. This has not been as safe haveny as you might expect. And the last couple days, last week was really a steep sell-off for gold. I mean, overall, again, compared to other markets, it's actually held up okay. And now what's interesting on the GLD is you're testing this low from the fourth quarter of last year. If you remember last year, third quarter, we had this nice rally, peaked out the first week in September. The fourth quarter was actually a pullback, retraced about 38.2% of that move, then rallied on to where we hit earlier this month, just a week ago. We're making new all-time highs on the GLD. Now we've pulled back down again, but we're right back at that key support level. So I see that 136 level as being really, really significant. Today put us back below the 200-day for the first time since the market low in December 2019. So I would not be surprised if we see a bit of a turn. We see some, out of the oversold conditions, see a rally a little bit. But, the GLD gold is actually oversold for the first time since back here last August of 2018. So it's quite a different environment. Gold is a safe haven, has not really worked if you look at the last little stretch, but on a relative basis has held up very nicely. So let's remember that. That is our market recap for today. I want to switch gears now to shifting stocks. So what we like to do is look particularly at a bottom-up process, what's working, what isn't. And a couple things I will tell you. Number one, we're going to look at scooter reports. We're going to look at some industry movements. We're also going to look at a specific sector, consumer discretionary, and dig in a little deeper on some of the patterns that we've seen there. So in terms of the big movers, and if you look at what's holding up here, and these are the scooter reports on what's moved up and what's moved down. You can see here it's things like Conagra, which actually had a nice bullish engulfing pattern today. So came from a low around 23 this morning, rallied up to close around 27. It's a 10% gain on a day when most things were down significantly. So again, we've talked in recent weeks when the market is down a lot, looking for things that are just up or not down that much. Big relative winners can be a great way to identify potential safe havens, potentially places to park a little bit as things recover. Perigo is another one. So, stocks like this, again, in the healthcare space, all else being equal, not the best chart in the world because it's pulled back a little bit, but it's pulled back to a support level from last summer. And the relative strength is actually going the way you want. It's coming out of an oversold region. The relative strength is actually increasing. So at a time when the market's struggling, the absolute price would actually look fairly, negative. It's not going to look that attractive, but the key right now, more than ever, it's always important. I will always tell you, look at the relative strength over and over. But on a time when we're worried about the market going down so much, even these stocks that I'm flipping through very quickly, they're not my favorite price chart, but some of these are actually holding up on a relative basis, and that's where I think you want to be paying attention to it. So Molson Coors is one, for example. This is down 1 2/3% today, which again, on a normal day, may be a bit of a cause for concern, but look at the buying that's been coming in just on Friday and then again today. So Friday, everything was sort of up. Today, most things have kind of come back down, maybe lows again, but you look at how TAP has actually held up pretty well. This is pushing it to a new, 3-month relative high coming out of the oversold territory. So I might be looking at some of those names. And again, I would pay less attention to the negativity in the price, pay more attention to the positive signals in the relative strength. Look for stocks making new relative highs. I did want to point out again, and again, please take more time and look at some of these themes, especially on a big down day. Look for some of the stocks that have gained in their scooter rankings. Those are ones that are boiling the cream that's sort of bubbling up to the top here. At the industry level, this is similar to what we saw in a lot of days last week. On Friday, gold stocks got hit pretty hard toward the end of the week, right? When everything else was rallying on the Trump announcement on Friday. Some of those groups like gold actually did not have as good of a move. You can see they were pretty sold off, had a pretty negative pattern, but look at how much accumulation you saw today. So these groups, gold miners and miners, were up over 4% on a time when the day was down over 12% right? So there's on a relative basis, pretty decent. You can see the other things, groups within consumer staples, a lot of consumer staples represented here. The only consumer discretionary group that's up here and still down 6%, but again, relative, made up a lot of ground today. Broadline retailers, also some telecoms, right? So you have mobile telecommunications up here. Again, not my favorite chart on a price basis, but on a relative basis, doing pretty well. In terms of what drove things down, the reason why real estate is one of the worst ones, it's all these REITs that have exposure to retail and all the companies that are going to potentially certainly struggle with all the changes that we're making in our day-to-day lives. It's going to impact a lot of companies, and it's going to be reflected in some of these. So it's going to be leisure places. It's going to be real estate sector, real estate groups that are related to travel, hotel and lodging, for example, things like that. It's going to be the apparel retailers that have to close their doors and don't have a takeout option of sorts, are going to be struggling a great amount. And then something like recreational products. So these are the groups that really drove things down big today. And again, it's based on a lot of those reasons that I just mentioned. And again, the percent moves that we're seeing are certainly much more dramatic than what most of us are used to, for sure. I did want to point out my next item in terms of shifting stocks was to remind you that it's a really good time to look at a particular sector. If you need to have exposure to a certain sector because of some sort of sector allocation model, or you have a minimum exposure you want to make sure you have to certain groups, I would remind you, even in sectors that are totally beaten down, there are usually pockets, or there are always pockets that are doing better than others on a relative basis. So if you stack every sector up and list out all the stocks from top to bottom, you are going to find some that are, at the upper end of that group of names, and others at the bottom name. So I just screened for the consumer discretionary members of the S&P 500. I put them into just ran the scan and put in this list, 66 stocks that are returned, and I've just sorted them by scooter ranking. So at the top of the list, these are the stocks within consumer discretionary that have the best relative positioning relative to all the other consumer discretionary stocks. So the order is telling you the strength. The scooter number, remember, this is related to all the other stocks out there, right? So it's looking at the entire large cap universe and identifying the names that are strongest or weakness in that group. What's interesting is some of these charts are actually fairly decent. And by decent, I mean not horrible. And that's sort of the bar. That is the low bar of attractive charts at this moment, is things that don't look horrendous, because a lot of things do. When I'm looking at Rollins, this is something that's come up on a number of our screens recently because of the strength in this line down here. This is the relative performance. This is a stock that has been making relative highs through pretty much the month of March. It went to a new relative high that first week in March and has continued to go higher and higher. And this is coming off the end of last year when it was down significantly. It was down, 30% relative to the S&P, and now has made all of that up year to date. So it's been a great relative winner. You can see it's actually holding above lows even from the end of last year. So it's nowhere near those lows still. It's holding up above them right at the 200-day moving average. And again, on a normal day, it's not the ideal chart in my mind, but this is a time when you want to be owning that line. You want to be owning stocks that are outperforming in this environment in your equity exposure. Assuming you have some equity exposure, let's go ahead and be in the places that are performing better than others. Amazon, Target, some big ticket retailers and big ticket names in here. Amazon, again, is something that's been breaking down. It's testing that low from last summer, and this is again from October. We're sort of down in the lower end of this range. If you think of the last year as a big range from these lows down here to the peak that we saw last month, we're definitely at the lower end of it. But look at how the relative strength has actually been accelerating to the upside. So as this has been selling off, just other names have been selling off so much more. That's what's, again, making it a relatively attractive thing. Target is another one. Again, this is a chart that's breaking down, and this is a clear distribution pattern in my mind. It's almost a head and shoulders like pattern. We have the peak surrounded by lower peaks. You connect the neckline, which would be the interim lows here. We've broken down through that. That measures not far from where we're at. Measures down to around 90 or so by my quick eyeball. And again, this is something that's reached the downside objective of that distribution, and the relative strength is turning up. So, my reminder with the segment shifting on stocks is, as much as you can with your equity allocation, thinking about your overall distribution of assets, be focusing on places where they're outperforming on a relative basis. Looking at the scooter rankings within a sector can help you identify, even in a sector that's down big, there are places that are actually doing okay on a relative basis. Again, let's go ahead and focus on being at some of those places. Folks, we're going to take a quick commercial break. Going to be back with my next segment on sector rotation. Let's look at it from a third angle. Think about sectors and movements there. So we'll see you back here in a minute. Hey everyone, welcome back to the show. Thanks for joining us every day for the final bar during the week to debrief on the markets from a technical perspective. We'd love to answer your questions, receive your feedback, get a message to us two ways. The final bar at StockCharts.com is the best way to get a hold of us at any point. Also, look us up on Twitter at FinalBarSCTV. I would remind you, in this sort of environment, when things do not seem so easy as they did a couple months ago, please use us as a resource. We're here to help you navigate these markets. Use the power of StockCharts.com to try to understand what's happening, empower you to make better decisions with your investments. So please, get any questions to us. Nothing is out of bounds. We'll do our best to try to help you answer those questions, helping you invest as well as possible. We're going to go to our next segment called Sector Setup. So what we love to do occasionally is look at sector rotation. One of my guests last week was Julius de Kempener. He created this visualization. We're going to start with relative rotation graphs years ago, and I followed his work for many, many years. When I was on the buy side, I actually used to get his research when he worked for a brokerage and talk to him in early days of RRG. I loved the visualization. We talked a lot about different ways we could use it, and we talked about this idea of putting it in motion. And I'm thrilled that many years later, all of us on StockCharts have the ability to take this visualization of sector rotation and actually push play and actually see how these things have evolved. That's an incredibly powerful tool. And what I just wanted to talk about was these last couple weeks, and then let's focus on where we're at today. Look at some of the charts of the individual sectors. If we start at the market peak here, this is beginning of the year. What I'll point out to you is what we've noticed is that the XLK technology has certainly been the leadership on a relative basis, right? And so further to the right, means you're stronger on a relative basis. The vertical is sort of the momentum behind that relative move. And as you can see, even during the market sell-off, the XLK has been sort of slow and steady heading due east. Now, northeast is better, totally granted, but holding up due east means it's continuing to outperform, which is what we want. Southwest is bad. Things like financials, things like energy, things like industrials are pretty much in a void based on this methodology, in my opinion, because they're going away from the position of relative outperformance. The things that are doing well are number one, technology. That's the, again, consistently the strongest place. You can see utilities, the other, second place, maybe healthcare might be a third. Healthcare had rotated down in the weakening quadrant, but did a quick 180, once again heading northeast. So those three are your strongest sectors based on this, followed closely by consumer staples and real estate. And these are the two here. Now, real estate obviously getting hit very, very hard today, again, based on all the exposure to consumers and retail locations. However, again, on a longer term relative basis, they're holding up pretty well. And I think this is an overall sort of movement away from traditional offense and into traditional defense. But what the XLK movement here is telling me that technology is serving more as defense than in previous cycles. And you might normally think of it. So if you look deep in history, you'll find something like tech probably wasn't as good, but now tech has become some big, powerful names that you would think would be able to weather this sort of storm. Things like Microsoft and Apple and other stocks of that sort of variety. Let's look at these sectors here, and let's look at the charts. And again, after I do the RRG, I like to look at the candle glance just to sort of see where all of them are at. Now, normally what I do is look at where they're at relative to their moving averages. At this point, all 11 of the S&P sectors are below, and mostly well below their 200-day moving averages. So that's no longer a great way to differentiate things across the board, sort of telling you that it's in a position of weakness. So again, as with most things, on an absolute basis, stocks are down significantly, which is why other places that we mentioned earlier, the dollar, some commodities, gold, for example, bonds, all holding up much better on an absolute basis. Totally fair. But on a relative basis, and that's where I think the RRG can be really, really helpful. Let's look at some of these charts individually, and we'll start to look at their relative movements in particular. I'm going to start with technology. We'll go through those three: tech, utilities, and healthcare. Let's just look at what the patterns are telling us. So with technology, we looked at this on the end of last week. The days are blurred a little bit in my head, but Thursday or Friday, I want to say we focused a little bit just on this chart and the fact that tech was nearing that 61.8% retracement level, which was just above 74, around 74.40 here. On a relative basis, you can see this is why on the RRG it's done so well. Just from the market low December of 2018, you can draw an arrow up and to the right, and that's pretty consistently what tech has done for you on a relative basis. It's just worked. And stocks and groups that do well in a bull market phase and also do well on a bear market phase on a relative basis, those are the kind of things you want to think of, in my opinion, as sort of a core position. That's sort of the main bet you should be trying to make, those sorts of charts, because those are things that are holding up in any environment, essentially. So what's happened now with today's sell-off, and again, tech actually finished above the open, even though we're well below the close from Friday. It was above 84 on Friday, back up to the 200-day. We've now sold off again, but again, I like the fact that it was above the open. That's good. Now I think this sort of support level is in play. We've arguably broken down below here. A confirmation, which would be a lower close, would confirm that breakdown of that level. And from a technical perspective, based on Fibonacci retracements, essentially says you want to brace for a return to the low of that range. You want to continue down to essentially the market lows from the end of 2018. That's another big sell. It's another 15 points on the XLK. So I would point as an interim low, this low from last June is where I would be looking. The Fibonacci lines actually lined up really well with the August low, which is why I thought it was so important. That may actually hold. We'll have to see what happens through the remainder of the week. But in the case of further downside, I think that's the next sort of line in the sand. If we break that level, we break 69 essentially, I think that would confirm further downside, and I would expect that to go down toward the December lows, which is sort of at a macro level, I think what the S&P chart is looking like as well. Let's look at utilities here. So this is sector number 2, and again, on a relative basis, it's been hurt a little bit in the last couple of days. Utes really came off while other sectors were doing well, and you can see the big gap down on Thursday. The rally on Friday, but again, not nearly as strong as some of the other places, and now has continued lower. Actually closed down more toward the lows of the day today. So overall, again, on a relative basis, short-term coming down. I think, the question now is this, a lower end of this trajectory going up as people get more fearful? Do they sell out of less utilities and more of other places? At this point, it's more of a wait and see mode, I would say, to be honest with you. The third one was healthcare. Now, these are obviously very news-driven stocks with a lot of speculation about, COVID-19, vaccines and things like that. And at some point, I think you'll find some boost that would come out of that. But I think at this point, it's sort of caught up in the overall market sell-off. This trend line is what we had used from the market low in December 18, again, lining up at the low from October. We tested that trend line, now have broken down below, and I think today really confirms that. On a relative basis, beautiful rally, and the last couple of weeks have been very strong for healthcare. So healthcare and tech, I would say, are the two that are really emerging as good relative bets in this environment. And then the last one I would just show you very quickly is consumer staples. I think there's a lot of question about consumer discretionary, especially with all these new regulations, new rules here in Washington State. They just closed all the restaurants and bars and such for the foreseeable future. Consumer staples, on the other hand, rallying significantly to a new 12-month relative high this week and last week as well. So again, on a lot of these sectors, the absolute levels are looking pretty outrageously bad, and I totally get that. Now more than ever, I would recommend using the RRG and looking at these relative lines. Screen for stocks looking more like this, and overall you're going to weather the downside much more than otherwise, I would hope. And ladies and gentlemen, we need to move on to our final segment, the 3 in 3. So at the end of every show, 3 charts in 3 minutes. And again, trying to boil things down to 3 charts in this sort of environment is a challenge, but hey, we're all doing what we can. So it's chart number 1. On Friday, we actually looked in our weekly wrap session, we talked about the long-term market trend model that I've used for a while. We've got a number of questions on this, and I'm sure we'll try to dig into it in a little more detail, but I just did want to point out, in this sort of environment, looking at some longer term charts and remembering what some of these other phases have been like can be very, very helpful. And again, I think the challenge we face as investors, especially younger investors, is this right half of the chart is probably their only experience with the markets. And to many investors, especially millennials, anyone that age, bear market, quote unquote, is something like these pullbacks that we saw in 2015, maybe 2018, maybe back here in 2011. That's what a quote unquote bear market feels like, which those of you that have been investing a little longer know that a bear market can actually be much longer and much painful, right? Things can correct in time and or price, and a lot of times a combination of both. I would remind you that the 2000 to 2002 cyclical bear market, the 2007 to 2009 cyclical bear market, both down around 50%, 50 to 56%. Again, don't grade me too closely on some of these percentages. I was throwing these up very quickly before the show just to kind of put things in proper perspective. So again, we are nowhere near that sort of destruction. But the point to remember is these downtrends took about 2 to 3 years at a clip. We've lost 20, 25, 30% of value in stocks in a couple of weeks. And that's why the severity of this is so different. So again, looking for a historical parallel, very, very difficult. We're going to do the best we can. Number 2 is TLT. Now, again, I would look across your asset allocation universe, look for places that are actually managing to gain. The TLT was up pretty good, up about 6.5% at the close, which is very decent. And again, on a price basis, bonds actually look very, very attractive. Again, with rates going lower, I think there's further upside there. Finally, the VIX. And I was talking to Grayson Rose, a fellow member of the StockCharts team. We were, comparing notes at the end of last week and again this morning on things. And he reminded me of the quote I shared with him and on social media a lot. Don't confuse the top of the page with resistance and its companion. Don't confuse the bottom of the page with support. We think mentally that things are constrained based on a range, but remember that extreme events cause extreme movements. The VIX is now at the peak. It's actually eclipsed the level that it was at the 2008 bear market bottom. We are at the highest level in the VIX that we've been for 25 years plus. So remember that a lot of things will become recalibrated. A lot of charts are going to look very different from here on out, which makes sense, folks. So ladies and gentlemen, that's our show for today. Thanks for hanging in with us as we check through all these markets. Please keep your questions coming to us, the final bar at StockCharts.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.